Srijan. I'm the head of the finance club, editor of the magazine Investment, etc. And I'm currently managing the portfolio of the finance club for around 4 months or so. Yeah, so just to give you a brief of my credentials so you can look upon it. Maybe you can contact me later if you want to join something regarding the Grow 90 thing, or maybe something related to finance club. You are most welcome. So yeah, we'll get started with the main content. So today we are going to talk about most of the things like share markets, stocks. But what exactly these are? These are a kind of investment, right? You should ask yourself a question: Why should one invest? Like, why exactly to put some money into another form of an investment? Why just not to keep the money as it is? So there might be a lot of reasons. You might be obligated to do something in the future. You want to generate returns out of it. You want to you want to gauge interest rate out of it. Yeah, maybe. But the one most common reason that everyone should invest is inflation. So what exactly is inflation? Inflation is something, the increase in the price of a commodity over time. If the amount of money that you are spending to buy the commodity remains the same, if the value of the money doesn't change, then the amount of commodity that you are going to buy in future will definitely be less, because inflation is a certain phenomena. It's definitely be going to happen. So therefore, if the money is lying idle, or it's not generating any return out of it, or generating any interest out of it, then the money loses its value of buying the commodities. When should one invest? That's the second question. The earlier the better. That's the most common answer you might have heard of. The reason being, the earlier you invest, the more is the time period that you got, and the better is the chances that the risk are less. Generally, if you want to generate higher returns out of a short time, the risk to be leveraged is more. Uh, Coming to the inflation part, how exactly is money going to, how exactly are investment going to hedge us against the inflation? The thing is, as you invest your money, you will be definitely getting interest rates out of it. You will be definitely be getting interest payments. These interest payments, they keep the value of the money at par with the rising commodity prices. So just to give you a brief info, there are two kinds of interest rate to be taken consideration in. The first one is the real interest rate, and the second one is nominal interest rate. So uh, the nominal interest rate is somewhat, we have heard a lot, as you see in banks or something, in savings deposit or in fixed deposits. In fixed deposits around 7%, for elderly citizens it's around 8%. The real interest rate is something which gives you a real increase in the value of the money relative to the inflation. So the real interest rate is the nominal interest rate minus the inflation rate that you have got. So this is what the basic of. How is the interest rate and interest on a particular amount is calculated? I'm talking in this sense, I'm talking about the bank interest rate. So just look upon those factors. So these are the factors. The first one is the demand for money. Second one, supply for money. Third, inflation rate. Fourth, RBI. As you can consider money as a commodity, as for any commodity, the demand and supply curves decide the price of the commodity. You can take it in a similar sense for money as well. Inflation rate, as I've already mentioned, that we generally do investment, or it's a compulsory requirement to do investment in order to hedge us against the inflation, right? So it's definitely be necessary that whatever the amount that you are investing should be more than the inflation rate. Otherwise, the investment is of no worth, because anyhow your money is going, the value of the money is going to be depreciated. If only it's equal or more than the inflation rate, it makes sense to invest the money, because in that case you will be hedged against the rise of the prices of the commodities. That's pretty much the inflation. Then RBI. So now every now and then you might be wondering that RBI has increased or downgraded the repo points by certain amounts, by 25 basis points or 50 basis points or so what. So there's a interconnection between the repo rate and the interest rate. Will not go into that deep because it's somewhat an economical phenomena which we are not trying to cover in this. So maybe in sequence of other webinars that we are planning, we'll definitely be covering a proper session on a bank so that we'll get a more broader idea. But as of now, you can take it that RBI has certain control over the interest rates. Yeah, so these are the different investment options available. There are multiple, but these are the majority ones. They have been arranged in the order of increasing returns, also in terms of increasing risks. That's an important point. So first is savings deposit. Savings deposit, as you might have heard a lot, it's like the most safest investment that you would invest your money into. The second one is bonds. Bonds is something, it's a contract that you gave a loan to a person, and that's pretty much it. But it's not exactly the loan sense. We're not talking about it in detail because it's a completely new topic, but it's, for now on, you can understand that it's a contract that some person has given money to another person. The third is equity shares. As you might have seen that I've just kept it in a certainly larger font. The main purpose is like the entire aim of today's lecture is equity and shares. So what exactly is a share? So as you can see, that it's an indivisible unit of capital which indicates the ownership in a company. We'll go segment by segment. So indivisible unit of a capital means a single unit of share can be held by a single entity or a single person. Then it indicates an ownership in a company. That's actually good. So that means that you are owning a certain fraction of a company. So suppose there are 5 lakh outstanding shares and you have one of them, then you are 1 upon 5 lakh owner of that particular company. With the shares, you not only get a ownership or partial ownership in the company, you also get the voting rights. So you'll have a say in the selection of the board of directors. Whatever the amount of votes, generally how the company divides the vote or gives you the voting rights is one voting right per one share. Sometimes it depends as well. Sometimes it's like one voting right per 10 shares as well. So it's variable, but the main thing is it gives you voting rights. Yeah, so that's one of the things. Now moving off to the next. Why companies issue shares? So there are multiple ways of generating revenues. There are multiple ways of generating cash flows. There are multiple ways of generating income. But the most common thing is when you start a business, you generally bootstrap it or you get it loaned entity. You generally loan the certain amount that you need to grow the business. But as the business grows, more capital is required. Every time the borrowings and loans may not be proved efficient, may not be proved sufficient in order to facilitate the expansion of the company. So what exactly are we gonna do? So we raise shares, we gave shares, we invite public to contribute to the growth of the company. We gave them a partial ownership, we gave them a share. By giving them the share, by selling them the shares, we get the capital that we require for the further expansion of the company, and the people got a partial ownership, and they can definitely be benefited from the growth of the company, but the partial ownership also means that you have to share both the risk and the returns alike. Moving on to the next slide. Yeah, so these are some of the characteristics of a share. The first one is face value. Face value is a nominal value which is assigned to the stock. So it's not of much relevance when we are talking about purchasing or selling the stocks. The value is generally fixed. Okay. So Reliance Industries Limited, the face value is 10 rupees. Market value, it is the price that which you can buy the share. Reliance Industries Limited, uh, the day before it was around 976 rupees, the closing price. Nine, but you can see the difference, that how market value and face value are seemingly not at all related. The face value generally has no significance and it does not affect the market value unless there's a stock split, which we are not coming upon it, like we are not considering about it. Yeah. So moving on to the market value, what determines the price of the share? It depends upon the demand. So if the company is performing well, if the company is performing great in terms of efficiency, in terms of manufacturing, then definitely people would be want to part of that growth story. The people would be interested in buying the partial ownership of that company. The people would be more interested in buying the stocks of that particular company. So this leads to increased demands, which finally leads to the increase in the prices. There's one more terminology you might have heard of, that's called market cap or market capitalization. It's generally calculated as, or it's calculated as market price multiplied by the total number of outstanding shares. So total number of outstanding shares, I mean that the total number of shares that people are holding. So that's the next term. Stock exchange. This is one of those basic terms that we heard in everyday life. So stock exchange is like a market where you can buy the stocks from a particular person, or you can sell the stocks to certain people or certain entities. So stock exchange provides us a platform where people can trade stocks, where people can be bought, or where stocks can be bought or sold. So in India there are multiple stock exchanges. The major ones are National Stock Exchange and the Bombay Stock Exchange. The next index, you might not get it might not get it in a first stroke, but if you heard, I hope that you might have heard of Nifty and Sensex. So Nifty and Sensex are an index. There are certain other indexes in other countries as S&P, Dow Jones. So what exactly is an index? So a stock exchange or a stock market index is a measure of a stock market, or sometimes a subset of a stock market. Subset of the stock market, by that it means suppose the Nifty and Sensex, the Nifty is a collection of 51 stocks, so it doesn't encapsulates the entire stock exchange, the entire stocks which are listed in the stock exchange. Rather, it takes the most trading stocks, the stocks which are traded most by volume, or there are certain other criteria as well. So getting these 51 stocks or 30 stocks, it indicates an overall view of the entire market, how exactly the market is performing. If the market is in the bull stage or the market is in the bear stage. So by bull stage I mean the market is, the Nifty or the index prices are increasing. By the bear stage I means that the prices are decreasing, the Nifty prices are. So it helps the investors to compare current price levels with past prices to calculate the market performance. What exactly does this past prices means? Past prices means the values which are dependent on maybe the past values, the 1995, generally an year prices are taken as a reference, and further prices are calculated as a ratio of that year price. The next, how exactly is Nifty price calculated? So these are some certain things which might seem a little bit calculative, but these are quite interesting. So we'll just go about this example in a short. So there are two companies. Assume that there are two companies, ABC and XYZ. So ABC has 600, out of which 200 are held by promoters and 400 are available for public trading. Just to give you a brief, what exactly are promoters? Promoters are the founding members of a particular company, or those members who are being there in the company from the initial stage. Generally, they tend to own a majority of the shares so that they have a majority voting rights. 400 are available for public trading. So 400s are listed on a stock exchange. That means there are 400 stocks which you of A by ABC which you can buy from the stock exchange. Similarly, XYZ has 400, out of which 100 are promoters and 300 are available for public trading. So the free floating market capital, is given by the stock prices multiplied by the amount of stocks which are available for the public trading. So it's given by 400 into 100 plus 300 into 200 in this case. The market cap in year 1995. So as I was telling in the previous slide, you take that the current prices level with the past prices to calculate the market performance. This reference year is taken to be 1995. Let this price be some 90,000. These are totally assumptive values and they do not have any real life significance. This just shows the method of how to calculate the index prices. So Nifty value is given by the ratio of these two. So it's given by 1 lakh multiplied by 1000 divided by 90,000. The 1000 factor is a factor which is being inculcated. It's called RBF. I'll come to it upon later. Yeah. So moving on to the next, different types of share issues. So share issues, there are different ways of buying a share. There are different ways of issuing a share. Issuing a share means when the company wants to raise a capital, they'll have to float the share somewhere. They have to get money, right? So they have to sell the shares in some market or other. So first is initial public offering. When an unlisted company means the company which does not have any of its share listed in the stock exchange. When it issues its share for the first time, the process is called initial public offering. You can think of as a launch of new product in a market. It's like a launch of new shares in the exchange that you can buy, right? The second is further issue. Further issue means sometimes a company may want to go on for a bigger project, which may be the part of the same entity. They want to generate capital out of it. For that, for further issue, the company has already some of its shares listed in the stock market. For a new project, the company needs further capital and it's issuing fresh stocks to be purchased, and in order to get more amount of capital for its project. So this process is called further issue. So it already has a stock and now it's again issuing some other stocks because it's in a need of capital for some other project. So that's pretty much summarizes it. Rights issue. For these two cases, initial public offering and further issues, these are available to every investor whether or not you are a shareholder of the company. For rights issues, the fresh securities are issued but only to the existing shareholders up to a certain date. Generally, some companies have certain kind of criteria that the companies give an advance notification that they are going to issue these shares maybe in July. Then they'll have to give a notification around January or February month. Then those of the investors who have the company's shares up to a particular date, maybe the date decided to be March, so that all those investors who have that company shares up to March 31st, they'll only be allowed to buy the securities that the companies are issuing. The last one is preferential issue. So preferential issue, it's only allotted to a selected group of individuals. Sometimes maybe the employees of the company or the selected group of individuals can vary. But again, it's a restricted issue. It's not open to everyone. That's one of the takeaway of the share issue. So yeah, why shares? This is one of the important questions. So the entire discussion revolved around shares, different markets, how the interest rates are calculated. But why exactly shares? Why other means of returns are not preferred, or they are not as rewarding as shares? So shares, it's been observed that they return high when held for a longer period of time. Sometimes they returns high even when held for a shorter period of time, but the risk for those things increases heavily and it's highly uncertain. Sometimes it's like a bet, but if you are thoroughly aware of the company, it can be a calculated bet as well. For a common investor, longer period of investment always are more safer and more rewarding. If you just look at the examples in the last 15 years, the stock prices have generated the returns of around 15 to 16%. If you compare this with a common fixed deposits, which is generating around 8% of the returns, it's almost double of it. So I know that the risks definitely are higher in the stock market, but even if you buy only the index, as in you just buy the Nifty prices, or just buy the Nifty or the Sensex, then also this figure seems to be very appropriate. If you invest in a particular stock, then the chances are there that you can get returns as high up to 27%, 28%, or 29%. So this is the data which has been taken for just a Nifty increase in prices. Further, stocks pay dividends. Now, what are dividends? Dividends are certain entity, or dividends are a share of the profit that a company generates and decide to distribute among its shareholders. It's just a share of profit and not the entirely profit. The company keeps certain amount of profit in order for its further expansion process or a growth process, and distributes the rest of the profit among its shareholders. So that's pretty much the dividend. So you not only the stock prices will increase, you'll always also be getting benefited in terms of the dividends that the company generally declare half yearly or yearly. So how share prices vary? There are two factors which generally leads to the variation of the stock prices. The first one is stock specific, the second one is market specific. Sorry for this mismatch in numbers, but yeah. So what are the stock specific factors? If you look at the stock specific factors, they are mostly company related. For example, as you have seen in the recent past that Yes Bank shares have fallen down drastically, right? This is a company related issue. It's not like leave apart the corona factor, but the problem is only related to the Yes Bank and not to the other companies. The problems may be in its balance sheet, maybe in its policies, or the company's growth seem to be uncertain. There are certain policies which hinders the growth of the company. These are the certain factors which affect the share prices. I'll just give you an example. For pharmaceutical companies, if a new drug is launched or if a new drug is patented, the stocks are generally going to increase, because in a pharma industry, if you have a patent, as you all be knowing about the meaning of a patent, you'll be having a sole right to manufacture that medicine, and if it's whatever the medicine may be, the company will definitely be ahead of its other peer competitors. So the getting a new patent in a pharmaceutical industry leads to an increase in the stock prices. So these are the stock specific factors that I was talking about. Market specific factors are certain economical factors, as well as they're highly uncertain in nature. Like, for example, if just for the sake, you can take the coronavirus case, which is a market specific, and the entire market is suffering from the cause. Sometimes a country declares a war against another country and the economy becomes unstable. That's also one of the factors. The growth rate falling down. Certain other factors, market specific, maybe the unstable government, politically indecision, and all those global factors which are contributing to the stock prices. So these are the market specific factors, and it's not specific to a particular company, but it rather affects all the markets at a whole. Yeah, so these are generally the types of stocks, and you can take it as the type of investing as well. So these are common investing interests that people go for. The first one is growth stocks. Growth stocks is companies which are growing faster than others. What you do is you want to be part of their growth story. You know that this company is already performing well and will continue to perform well. So for example, if Reliance is performing well, if Reliance is generating good amount of returns, you just want to buy some of the shares, because you know for sure that in the future as well the company will continue to maintain its pace. If not so, then also the stock prices are definitely going to increase because the company is continuously improving. So that's called growth stock. These stocks are now, one thing about the growth stock is everyone knows about growth stock. So it's not that a proper research that you have done out of it. It's like the common market tendency of buying that particular stock, and it's most of the people who don't want to do a lot of analysis, who don't want to go for a lot of time consuming analysis, they generally go for buying growth stocks. It makes sense because doing an analysis would require a lot of time, and sometimes it's not feasible for you to generate that amount of it. For the second is value stocks, the stocks which have been overlooked by investors. The thing is, if you look upon certain companies, I'll just give you an example. Some of the investors were very sure that with the launch of Clean India Mission, the dustbins demand will definitely be increasing. The major company which have been manufacturing dustbin was Nilkamal. Now, this is something which many of the investors haven't been able to gauge. Some of the investors have figured it out that after this scheme, the prices of Nilkamal will definitely be going to increase. So they put their bet on Nilkamal, that they know that Nilkamal's profit is going to be increased, and currently it's not as highlighted in the market, but it will definitely be in the future. They buy the stocks and it gave a higher return. Now, one thing about value stocks, they are difficult to find for sure, but if you are able to find them correctly or you have done proper analysis, they are definitely be able to generate more returns than growth stocks, because market will somehow or another, at some time or another, will definitely find their value and they will become growth stocks. Since you are part of the growth, since you are part from an early stage, you have definitely be bought it at a lower prices and it will end up in a higher price. The marginal difference will be more for you. So these are certain aspects. If you have a lot of time, you want to generate a larger amount of return, go for the value investing. If you want to just do investing as a part of your growing strategy or to generate returns out of it, not doing a lot of analysis, then go for the growth strategy. So these are the two terms that we'll be covering. That's one more, bid price and ask price. So when the stocks are traded in the stock exchange, bid price is something at which a buyer is ready to buy the stock. So suppose you want to sell the stocks and you want to see that, okay, the buyer will at this price, this buyer is ready to buy the stock, or how many buyers are ready to buy the stock at this price. This is generally called bid price. This is generally help you when you are looking to sell the stocks. Ask price is when you want to buy the stocks, you will see which is the price at which the seller is ready to sell the stocks. Generally, ask price is taken to be lowest available price at which the seller is ready to sell, and bid price is generally taken as the highest available price at which the buyer is ready to buy the stocks. So when you want to buy the stocks, look for the ask price. When you want to sell the stocks, look for the bid price. So this is a very basic terminologies. The next one is portfolio. Portfolio is a collection of various financial instruments. It may consist just of shares, but that's a very rare case. Generally, people do hedge it with investment options which are available with different amounts of risk. So bonds generally are lower risk instrument, shares are higher risk instruments. Then people go for options, derivatives. Options, derivatives and bonds are a comprehensive topic and would require a separate lecture to be on. So we'll be covering later on. They are not as simple as shares. So this is what a portfolio generally comprises of. What exactly is the purpose of creating a portfolio? So it is possible that you just buy a 2 or 3 stocks and just put some amount of money on 2 or 3 stocks, maybe from a single sector. Suppose you have bought 2 or 3 stocks of an auto sector and then certain regulation came which struck the auto sector bad. Then what will happen is the prices at which you have bought will definitely be going down. In that case, what will happen is you won't be able to hedge the risk against certain market uncertainties. If you have stocks which are gauged or which are spread across various dimensions or various industries, then in that case it will be definitely possible that if certain industry is going down, then the other industry is either stagnant or rising up. In that case, the price of one of the stocks going down is hedged by the other stock going up. So there's a balance being maintained. It's sometimes you might be thinking that, okay, what happens if the share prices all the sectors goes up? Then you definitely be generating more interest than what others are doing, right? But in that case, the risk that you are taking in order to generate that amount of returns is very high. It's always better to go for a diversified portfolio. You spread your investments across different dimensions, not across the dimensions which are highly correlated, but the dimensions which gave you a share advantage, so that even if one of the stocks is going down in a particular sector, you'll definitely be able to have something in order to hedge it. So you hedge it generally using options, futures, bonds, shares across spread across various portfolios. This is particularly the whole idea of diversification. Now, for many of the investors, creating a portfolio seems to be a difficult option. Like, how exactly are they going to gauge that, okay, this stock will be able to hedge the risk against the other stock? For those investors, it's always better to either buy Nifty or Sensex. The best way is, since they already are a collection of around 51 stocks spread across different industries. So it's never possible unless a very rare scenario happens, or even if only there is a market risk involved. In that case also, you will be able to gauge the risk, and you will be able to set some modifications that you will be much more safer than buying a single stock. So if you don't want to invest a lot of money in selecting stocks for the portfolio, it's always better to buy the index stocks. The Nifty 50, these are also, Nifty has also a lot of varied portfolios, as being said as Nifty Auto, Nifty IT, Nifty Pharma. Nifty Pharma will have around 51 or 50 to 51 stocks in the pharmaceutical sector. So it will have all the stocks in a particular sector. If you want to mitigate against the stock risk or a company risk, go for those smaller sections. But if you want to hedge against any sector fall down risk as well, then it's always better to go for Nifty or Sensex stocks. So you'll get a basket of predefined stocks, and since they met a precondition, they met a certain criteria, it's more or less your investment is going to be safe, and you are able to generate a good return out of it. As I've already mentioned, that Nifty has generated around 15 to 16% in the last 15 years, which is twice as you might have deposited in the savings account, and it's much more safer than any buying a single stock. So this is pretty much the idea of portfolio and diversification. We'll just cover a single more topic and then we'll wrap it off. So for those investors who don't want to actively participate in the market, who don't want to spend a lot of time checking out the stocks, tracking the stocks, how the company is performing, it's better to do a professional fund manager for them. This is what exactly mutual funds do. So mutual funds, it's generally managed by an entity which are having professional fund managers who are experienced professionals. They pool out money from many investors. So you are buying a unit of that particular mutual fund. So you don't have to put a lot of your brain. You just have to buy those stocks, and that person will be generating returns out of the investments that he has gathered by purchasing several sort of securities. The interest or the returns that you will be getting out of a mutual fund may be less, is generally less if you are investing directly into the stock market, but the advantage is your fund is being managed professionally. So if you don't have that much of a time to invest upon those things, in order to look for the stocks, in order to look for an opportunity, rather go for a mutual fund and let a professional fund manager do it for you. So that's one of the safest options if you want to buy it early. If you don't want to spend a lot of time, mutual fund is one of the safest options to be invested upon. So this pretty much wraps up. We have tried to cover a large number of basic topics. We'll be covering upon bonds, derivatives, options in the later webinars, and by the end of this webinar series you'll be able to buy your own securities and you'll be able to maintain your portfolio. We'll brief you upon how to make through a stock selection, how to look for an opportunity, what are the how to look how to analyze a company, how to analyze the growth of a company. These are the things that we should be looking upon. So signing off, guys. Thanks.